Okay, so we'll now move on and we'll look at part B of PFF Outcome 2. We'll see the question here is that we've been informed that if the volume of material purchases fall below a certain level, Rousseau and Co. will lose the discount they currently receive from suppliers as follows. If material A falls below 30,000 kilograms, there'll be a 10% increase in price. If material B falls below 20,000 kilograms, there'll be a 5% increase in price. And we've been asked to recalculate the total budgeted profit for the business. Or does make or buy recommendation A, amending material costs where necessary. So there'll be two parts to this then. The first one is we're looking at the new budget under the make buy decision. So we're taking into account that we're making in some components and buying others. And the second thing is the potential loss of a discount. These are the two factors we've got to consider when we calculate the new budget. So first thing we have to do then is determine whether or not we're going to lose the discount. So if material A falls below if material A falls below 30,000 kilograms, there'll be a 10% increase in price. And if B falls below 20,000 kilograms, there'll be a 5% increase in price. So the first thing we need to do is determine whether or not material A, the amount used, falls below 30,000 kilograms. And if it does, we're going to have to increase the price of material A by 10%. So first of all, we want to look at the amount of material A we're currently using, and the same with B. So for Balzac, we'll see that the amount of material we use is 1,000 units, and for material A, we're using 2 kilograms per unit. So 2 kilograms per unit times 1,000 units is going to mean we've got 2,000 units of material A. And material B for Balzac, the amount we're using is going to be the kilograms per unit is 5, multiplied by 1,000 means we're using 5,000 units. Forgive me, we're using 5,000 kilograms of material B for Balzac. And same idea for Hugo. The amount of material we're using is 4 kilograms per unit times 1,000 units means we're using 16,000 kilograms of material A on Hugo. And the amount of material B we're using is the 2 kilograms per unit times by 4,000 units, which means we're using 8,000 kilograms of material B. I just do the same sort of calculation going along all the way for each of the components, calculating the total amount of material being used for each of them. So the amount of material B for Zola will be 2,500 times the 4 kilograms per unit, which give me 10,000. So that's the current budget when we're making all 4 components. The total amount of material A we're using is 70,500, and the total amount of material B we're using is 38,000 kilograms. It has said, however, we have to decide if we make the make or buy decision, we'll lose the discount if it falls below 30,000. So we've got to see, we were getting a discount previously because it was above 30,000, and for B, it was above 20,000. We're using 38,000 kilograms of material B. If it falls below 20,000, there'll be a 5% increase in the price. So we now need to have a table showing how much of the material we'll use after the make buy decision. So we've chosen to buy in Balzac, forgive me, we've chosen to make Balzac. We're buying in Hugo and Voltaire, and we've decided that it's cheaper to make Zola. So the two that we're still going to be using are Balzac and Zola. So we're still going to have these materials here. We're still manufacturing Balzac, so we're still going to need 2,000 units of material A and 2,000 kilograms as well of material B. But because we're buying in Hugo and Voltaire, we're not going to need to buy any material to manufacture them, which means the amount of material we need to purchase, the amount of material A we need to purchase to make Hugo is 0 and Voltaire is 0. And that's true for material A and material B. We don't need to buy them because we're not going to use them. We've chosen to make, though, a Zola, so we're still going to use 22,500 kilograms of A and 10,000 kilograms of B. We then get the total amount of material we're using by adding them up. So for material A, after the make buy decision, we're going to be using 2,000 plus 22,500 kilograms of material A, which means we're using 24,500 kilograms of material A. And just using the same math, just adding all the numbers up, we'll be using 15,000 kilograms of material B. So we check then if we're going to lose the discount. So we started off with 70,500 kilograms of material A, but we're obviously getting the discount because we're using more than 30. Now we're only buying 24,500, so it's slid below the 30,000 mark, which means we're going to lose the discount, and as a consequence, prices are going to rise by 10%. And the same thing's happened with material B. We're using less than 20,000. We were using 38,000. It's down now at 15,000. So it's fallen below 20,000. It's triggered a price increase. We're no longer buying enough to qualify for the discount. And the consequence is material A and material B are going to increase in price. It's going to increase in price by 10% for material A and 5% for material B. So we're going to make a new budget with these two things added onto. So lots of discount on both material A and material B. So we'll make a new budget, taking account of the make-buy decision, and also recognizing we've lost the discount and the price of material A and material B are going to increase. So the budget's going to follow the same pattern as before, which will be sales revenue, take away variable costs, take away direct expenses, to get the contribution, then the fixed cost. Get the contribution, we take away the fixed cost to get the profit. Basically, it's going to be the same layout, which will be the sales revenue, take away the variable costs, we then get the total variable costs. Then we add on direct expenses to get total marginal costs. But the one difference here is that this part here, when it gets to total variable costs and direct expenses and total marginal costs, we have a new cost in here, which will be the supplier costs. So we'll have to add on the supplier costs as well, which will just come instead of the marginal cost. Total marginal cost is going to be 0 for these, for the ones we've purchased in. So maybe we'll look at Hugo and Voltaire, how we calculate them, since they're in some ways the easiest to calculate now. So the sales revenue is going to be the same as it was before. It's just going to be the 400,000, which is the 4,000 times the 4,000 units sold times £100 per unit. So it's going to be £400,000 sales revenue for Hugo. Same idea for Voltaire, same amount of sales revenue. It's going to be the £1 million, which is just the 5,000 units we've sold times the £200 per unit. So sales revenue is going to be the same for both of them. But this time, instead of taking away the material costs and the labour costs and the variable overhead and the direct expenses, this time we're just taking away the supplier costs. And the supplier cost is going to be the cost the supplier's charging us, which is for Hugo is going to be £90, and we're going to multiply the £90 by the 4,000 units that have been sold. So 90 multiplied by 4,000, the £90 times the 4,000 is going to give us 360,000. Same idea with Voltaire. It's going to be the £85 the supplier's charging times the 5,000 units is going to give us £425,000. So to get the profit in each of the units, it's going to be, for Hugo, it's just going to be the sales revenue, take away the supplier costs, means we can get a contribution of £40,000. And for Voltaire, it's going to be the million, take away 425,000, which will give us 575,000. So that's how we get Hugo and Voltaire complete. So we'll look now at getting how we complete Balzac and Zola. So we get the sales revenue the same way we always did, which was just the same sales revenue it was before, which is the price times the quantity. So for Balzac, it was 1 million times, forgive me, it was 1,000 times £120, which was 120,000. It's going to be the same 120,000 again. But now remember, we've lost the discount in material costs. So the material costs are going to increase. So the material price change is going to rise by 10% for A and by 5% for B. So for Balzac and Zola, the material prices are going to rise by 10% for A and 5% for B. So if we look at the material cost of A, it was 2,000. it's now going to rise by 10%. So there's two ways you can get that. So the original price, you can calculate it the slow way, which will be the original price was £2,000. It then increases by 10%. So the 10% increase, so we get a 10% increase, which will be 10% multiplied by 2,000, which will give us 200. The new price, the higher price, is going to be the 2,000 plus the £200, which takes us up to the £2,200 for material A. So that's the kind of slower way of doing it. A faster way of doing it would just to be to say the new price is going to be the original price of 2,000 times by 1.1, just basically 1 plus the 10% increase. So 2,000 times 1.1 gives us 2,200. But what I've done here, I've just done the original price, the 2,000, times by 1 plus the price change of 10%, which is giving me 2,200. So again, you could do it in Excel, or you could do it in the calculator, just 2,000 times 1.1. So 1 for being the original amount plus the 10% of the 200 gives us 2,200. And it's the same idea with Zola. The price of Zola originally was, the material cost of A was 45,000, but now the price has increased by 10%. So to get that, we add on 10% to 45,000. And again, the easiest way to calculate that would just be 45,000 times 1 plus 10%, or 45,000 times 1.1, which in this case will be 49,500. Same idea with material B's new cost. It's increased by 5%. So this time, instead of increasing by 1.1, it increases by 5%. So we see material B for Balzac used to cost 25,000. So the original price was 25,000. So we'll just get this table here. So the original price was 25,000. It's increased this time not by 10%, but by 5%. So instead of multiplying them by 10%, I'm going to increase it by 5%. And 5% of 25,000 is 1,250. So the new price is going to be 25,000 plus 1,250, which is the 26,250. The easiest way to do it, again, I would say, is just get the original price and times it by 1 plus 5%. So I've got the 5% here. So the original price was 25,000. We've multiplied it by 1 plus 5%. You could write it like this, or you could just write 1 plus 5%, and we'll still get the 26,250. So I've just done the original price times 1 plus 5%. Make sure you've got the 1 plus 5% in brackets like this. If you do it like that, and we get, in the calculator, it would be 25,000 times 1.05. And the same idea with Zola, it's the same number, so it's going to be also 25,000 times 1.05. 25,000 times 1.05 is also going to be 26,250. So that's got the material costs. The labour costs and the variable overheads are going to be the same. They've not changed. So the labour costs and the variable overheads are going to be the same. The only difference is for the product or the products that we choose to buy in, we're not going to have any cost for them. So the labour and the overheads are going to be the same. We get the variable cost the same way we always did, which is we add up all the individual variable costs. So for Balzac, material A plus material B plus the labour overhead plus the variable overhead gives us the total variable cost. The direct expense is still the same, so we still have to use that machine for Balzac, the £10,000 machine we have to hire. Then we get the total marginal cost is the total variable cost plus the direct expense gives us the total marginal cost. We then get the contribution by doing sales revenue, take away total marginal cost to get contribution. So the sales revenue, take away the total marginal cost, gives us contribution. So in this case, it's going to be £120,000, take away £74,450, which will give us £45,550. Exact same idea with Zola. The total variable costs, or all the variable costs added together. We add on the direct expenses to get the total marginal costs. And again, the direct expense is still going to be just the same number it was, the 22,500 in the original budget. No changes there. The only thing that's changed for Balzac and Zola are the material costs. The rest are all kind of the same. So then get total contribution by doing the sales revenue for Zola. Total contribution for Zola will be sales revenue for Zola of 175,000. Take away the total marginal cost for Zola of 155,750, which give me a contribution of £19,250. I think it should then have contribution for all of the 4 products. Balzac and Zola are got by sales revenue, take away the total marginal costs, and the difference this time is material A and material B had increased. A had increased by 10% and B had increased by 5%. But done it just the same way I always done it. For Hugo and Voltaire, we run the sales revenue, take away the supplier costs to get the contribution. I then got the total for contribution by, again, 2 ways I can get it, either by doing the total sales revenue, take away the marginal cost plus supplier costs, so 1,695,000, take away 230,200, take away 785,000, or could get it just by adding across the way. So get the total contribution by just adding across the way here, just equals sum all the individual contributions, one up to the total contribution, which in this case is 679,800. I then take away the fixed costs, which are just the same fixed costs as they were before, which is the 80,000. So get the total contribution, take away the fixed costs, and that gives me the profit, which this time is £599,800, which is, we can see, a little bit better than it was originally. So might sound convoluted here, but there's only sort of 2 parts that we're sort of getting at. We're just making a table to see whether or not we lose the discount. Then we're making a new budget. In the new budget, we've made 2 changes. One is that we've increased the variable costs for the components that we're making, the material costs of the components we're making. And the second thing is we've taken account of the fact that we've chosen to buy in some components, and the components we buy in, the variable costs will all be 0. And we'll just have a supplier cost instead then to reflect the amount that we're buying it in for. So if we do that, we'll come up with a profit for B.